Welcome to PhillipCapital Market Watch. Today we're going to talk about the Singapore equities and corporate high yields. We believe that the Singapore equities can continue to perform well till March 2011. The benchmark index for Singapore equities rallied 13% from late August to early November. However, as we head into the year end, the index is trading at the upper end of its bull run. We expect STI to experience a 5% pullback from the 3,200 level and establish a good price level base there. We feel that a possible pullback will help to ease some overbought pressure on the local equities before we can see a further leg up. So far, the biggest correction for the STI since March 2009 has been at 13.3% during the month of May. On a side note, volume is expected to decline as liquidity dries up upon the festive season. But on the high side, Singapore equities are still fairly priced at a PE ratio of 15, and the strong performance of local economy will provide a further boost to local equities over the next few months. On the fixed income market, despite the recent rise in US and Singapore Treasury yields, we feel that investors can still consider to increase their exposure into the corporate high yields, also known as the junk bonds. What we have observed is a continuing decline in the default rates on global junk bonds. The trailing 12-month default rate as of November 2010 came off to 3.3%. Not too long ago, in November 2009, that figure was 13.6%. In fact, Moody projected the default rate to fall to 1.8% in 2011. A lower global speculative default rate will tighten the yield spreads. Fundamentally, we view the corporate balance sheets are much healthier now as their leverage ratios came down from the 2008 highs. Therefore, we feel that unit trusts which invest in corporate high yields will continue to perform well in the next few months. That's all we have for you today. Thank you.